This is Nightly Business Report with Sue Herrera and Bill Griffin.
September surprise, August was good to investors, but when the calendar turns, history says things could get a bit rocky.
No deal yet. A dramatic day of trade negotiations between the U.S. and Canada leaves a critical economic relationship in limbo.
And location. Not anymore. Why real estate for millennials is all about the pets. Those stories and more tonight on Nightly Business Report for Friday, August 31st. And good evening, everyone. I'm Tyler Matheson in tonight for Bill Griffith.
And I'm Sue Herrera. Welcome, everybody. Well, stocks sizzled in August, avoiding the summer doldrums. This month, we saw the bull market become the longest in history. The S&P 500 and the NASDAQ hit records, and in fact, this was the NASDAQ's best August in 18 years. But the final trading day of the month saw a flat finish for the major averages. The Dow Jones Industrial Average fell 22 points to 25,964. The NASDAQ was up 21, and the S&P 500 rose a fraction. For the month, the NASDAQ was the big winner. But now we enter September, a month that's not always friendly to investors. Mike Santoli has more.
September has a well-earned reputation as a tough time for the stock market, but the month doesn't live up to its threatening profile every year or under all conditions. Since 1950, September is the weakest month for stock returns, with a slight loss on average and more years down than up. Counting just midterm election years, the history is similarly skewed to the downside. The cause of this turbulence at summer's end is not entirely clear, but some of the causes are worth considering. In decades past, the blame centered on mutual fund managers aggressively selling their losing stocks ahead of their October fiscal year end, but this factor has diminished with the reduced significance of mutual funds in the markets and the move of many fiscal years to December. Another more recent culprit, a tendency for analysts to slash corporate profit forecasts for the coming year in September after summer slowdowns and revised growth expectations. Yet this factor is far more relevant when companies are struggling than in an earnings boom like the one we've seen this year. And it's worth noting that September's downside bias for stocks is also most pronounced when stocks have been weaker through the summer. In fact, when the S&P 500 index has been up in each month from April through August, as is the case this year, September has averaged a healthy gain. In stronger years, too, even a wobbly September has tended not to touch off a slide through the fourth quarter. Over the past 20 years, when the S&P has been up at least 5% for the year to date, by Labor Day, the final 4 months of the year have been higher every time by more than an additional 5% on average. Given that the index is heading into Labor Day 2018 up by more than 8%, the onset of September this year might seem a bit less fearsome for investors. For Nightly Business Report, I'm Mike Santoli.
All right, let's talk more about what may be ahead for stocks with Brian Nick. He is the Chief Investment Strategist at Nuveen. Brian, welcome. Good to have you with us. You point out that throughout the summer, whenever there has kind of been bad news or worrisome things for the market, it has been counteracted by good news, good earnings, good news about the economy, GDP growing 4.2%. In September, there may be a little bit of a vacuum of good news to offset whatever bad news we get. That's your point, right?
Yeah, Tyler, thanks for having me. Yeah, if you look back at March and June as comparable periods, those are months when we weren't getting corporate earnings data because corporate earnings data comes in the first couple of months of the quarter, not in the last month of the quarter. So now that we're not going to have the good news about what we think are going to be pretty healthy rises in corporate profits, something else is going to fill that vacuum, whether it's news about trade, whether it's something geopolitically that's occurring, and that tends to be much less friendly for equity markets.
Also, the Fed is widely expected to make its next move on interest rates as we go into this fall. What impact might that have on the market, if any at all, because it's been pretty clearly telegraphed by the Fed that they will continue to raise rates?
Yeah, we think if the Fed wasn't going to raise rates in September, they probably would have had to start to say that to the markets already. So we, in all likelihood, will get a rate hike in September. So that won't be that disruptive. But the question is, what is the Fed going to say around that rate hike? Are they going to revise their expectations for growth or inflation higher or lower? That could certainly factor in for the markets. And now the Fed also tells us something about what they think the next couple of quarters are going to hold for what they might do with rate hikes. So if they change that outlook at all, if they say we're going to be hiking rates more than we said last quarter, that could certainly be a pretty big market impactor as well.
Are you bracing for a sell-off in September or just for more volatility in September?
I think just more volatility rather than a more market sell-off. We still think economic fundamentals are quite strong in the United States. They're solid outside the United States, but you still have the prospect of an election in Brazil in October that could certainly create volatility in Latin America and emerging markets. The Turkey situation is unresolved. Argentina just raised their interest rate overnight to 60% to fight inflation and the perception that they have a falling currency themselves. So there's lots of other sources of risk, and without a lot of reliable, steady, good news coming in on the corporate profits front, it's likely that bad news will start to impact markets on a day-to-day basis. But we don't think this is the start of a larger or a longer-term sell-off.
So where is a long-term investor to take cover to try and weather the volatility that you're expecting?
Well, we still think secular growth stocks are the number one place to be in the United States. We're looking at the healthcare sector, technology sector, consumer discretionary stocks. We still believe that story has room to run, although the valuations have crept up this year. Those stocks have become a bit more expensive. And we're looking for room to buy emerging markets. We've been constructive on emerging markets. There's been a pullback, especially in their currencies. And we're looking for ways to take risk that's in a prudent way that isn't taking too much additional EM risk in the portfolio. But when something falls this much without a drop in fundamentals, typically it's a buying opportunity for investors who have a long-term outlook.
Brian, have a great long weekend. Brian Nick is with Nuveen. Thanks again.
Thanks very much. You too.
Well, there was nothing straightforward about today's trade talks between the U.S. and Canada. The negotiations were tense, there were surprises, and in the end, no agreement was reached between the U.S. and its biggest trading partner. The negotiations broke off midday, seemingly abruptly, and then came word that the discussions will pick up again next week. Eamon Javers is covering the story for us. Eamon, it's like a professional ping pong game. Run through the events of today.
That's right, Sue. Well, it was a wild one today. We had all kinds of intrigue in the afternoon, but ultimately we landed at the end of the day Friday with no deal. But they do have an agreement to continue talking between the Canadian and the U.S. sides here in Washington, starting, we are told, on Wednesday of next week. We also had this bizarre moment where some off-the-record comments that the president had made in the Oval Office to Bloomberg News were leaked to a Canadian newspaper. Those comments apparently embarrassing to the U.S. side, the president having said in those off-the-record comments that he wasn't going to make any concessions at all to the Canadians, but he didn't want to say that publicly because he wanted them to come to the table and agree to a deal and didn't want to, in effect, embarrass the Canadian side. So at the end of the day, we heard from Chrystia Freeland. She's the top Canadian negotiator working in Washington, and she was asked about some of the big personalities involved in all of this. Here's what she said.
How can you possibly negotiate with a guy like Donald Trump who says that he's not going to give any ground? That's not a negotiation, is it? Like, how could you possibly make a deal with someone like that?
My negotiating counterparty is Ambassador Lighthizer. And as I said, he has brought good faith and goodwill to the table. As I also said, it is going to take flexibility on all sides to get to a deal in the end.
And as for the president today, he was in North Carolina. He laid out some of the consequences potentially for Canada if we don't get a deal. Here's what he said.
If we don't make a deal with Canada, that's just fine. But we'll see how it all works out. I say affectionately, we'll just have to tariff those cars coming in. That's a lot of money coming into the coffers of the United States.
So, Sue, the president laying down a tariff threat to Canadian automobiles. That's a big one, a big, important sector in Canada. And the Canadian negotiators are very sensitive about the fate of their auto workers in all of this. Now the question is what happens. The U.S. said the administration has officially notified Congress that they're beginning the so-called 90-day clock here to renegotiate NAFTA. But they've said they're not sure whether Canada will be in that deal or out of that deal when the time comes for something to be signed here in Washington, D.C., Sue.
It was very interesting. Chrystia Freeland is an extraordinarily adroit parrier of journalists, having been a journalist.
That's
but at
right.
one point she was asked, did she think the U.S. was negotiating in good faith? And there was an unmistakably long pause there. Later in the day, she seemed to go out of her way to say, yes, the U.S. was negotiating in good faith.
Yeah, that's right. That might indicate some of the tensions throughout the day. You know, everything was disrupted this afternoon when we saw that leak of those off-the-record comments that the president made privately to Bloomberg News reporters. Not clear who leaked it, whether it came from the administration, from that news organization, or from some other mechanism, but it ended up in a Canadian newspaper, and it caused a lot of attention to be paid to what was going on here in Washington today. A real hiccup at the end of this tense negotiation, and now we're told they're simply going to punt it until next week.
Eamon Javers. Eamon, thank you so much.
You bet.
Reporting from the White House tonight.
Well, Ford has canceled plans to import a new crossover vehicle from its plant in China. The automaker cites import tariffs that were put into effect last month. The vehicle was expected to replace the Ford Focus in the U.S. late next year, but the company now says the economics no longer make sense following a 25% tariff.
The Trump administration is considering linking capital gains taxes to inflation. Now, that means the taxpayers could adjust the initial value of an asset for inflation when selling it, potentially reducing the amount of capital gains tax they would need to pay. Critics say such a move is tantamount to a tax cut for the rich. A similar measure was considered by George H.W. Bush, but it was ultimately dropped.
The president wants to ease retirement account rules. He signed an executive order today that calls for a review of how required minimum distributions from 401k plans and IRAs are calculated for people older than 70 and a half. He also wants to make it easier for small business owners to group together to provide workers with retirement plans. The White House says high costs currently discourage employers from offering the 401k accounts.
Coke is after a coffee fix. The Dow component is buying the British coffee chain Costa for about $5 billion, making this Coke's biggest brand acquisition in its history. But the deal is raising some questions, and shares of Coke fell in trading today. Sarah Eisen has more on Coke's push into cappuccino.
Coffee is hot. It's growing faster than most drinks, 6% globally, and that growth is what Coke is after. But it's the retail side of this deal that's raising some questions. Costa has 4,000 stores across 30 countries. It's #1 in the UK. So I asked Coca-Cola CEO James Quincy, why retail? It's not Coca-Cola's business or expertise. He said, clearly part of the coffee strategy is having stores because they build business and the brand. We are buying a great management team that knows what it's doing in retail. Clearly not our core competence, he admits. Along with roasting coffee, that's what they're bringing. We are bringing global scale. According to Quincy, we can introduce different formats as a total beverage provider. In some places, you might see stores, beans, machines. In the U.S., he says, they don't want to go toe-to-toe with Starbucks opening coffee shops. It would be more of a focus on Coca-Cola's relationship with food service, big restaurants, and big business. Costa also has vending machines and, of course, beans and pods that they sell in grocery stores.
It makes sense in terms of then having to get into coffee. Hot beverages are growing much, much faster than their Coca-Cola franchises, than their cold beverages. So I get why they're trying to diversify into this. I don't understand why they had to buy something. I don't understand why they spend $5 billion to do it.
Here's the reality for Coca-Cola. According to Jefferies, almost 70% of Coke's volumes are in sparkling beverages. That's brand Coke, Diet Coke, Sprite, lower growth beverages. That's why Coke is ramping up the portfolio in higher growth areas. Sparkling water, tea, coffee, sports drinks. Remember, it took a big stake in Body Armor just a few weeks ago. That was also the logic behind PepsiCo's recent $3 billion deal for SodaStream less than 2 weeks ago. In fact, these are the biggest deals for both beverage companies in years, showing they're getting aggressive when it comes to pursuing growth and following where the consumer's going. For Nightly Business Report, I'm Sarah Eisen in New York.
Time now to take a look at some of today's upgrades and downgrades. Electronic Arts was downgraded to neutral from buy at Bank of America Merrill Lynch. The analyst cites the crowded holiday slate of games expected to be released. The price target now, 126. The stock fell 2% to 113.41. And the same analyst at Bank of America Merrill Lynch, busy day for him or her, also cut the rating on Activision Blizzard to neutral from buy. The analyst cites increased competition from the popular video game Fortnite, very popular in my house. The price target now 77. The stock fell more than 2% to 72.10.
Lululemon's price target was raised to $175 a share at Cowen. The analyst cites the company's sales momentum and international expansion following its earnings report yesterday. The firm's rating on the stock is outperformed. The stock rose 13% to $154.93. VMware was added to the top picks list over at Oppenheimer. The analyst is upbeat on the company's ability to execute on its cloud strategy. The price target is $180, and the stock fell just a fraction today to $153.26.
Ready, set, hike. The NFL doubles down on its digital strategy, but is it enough to offset a persistent decline in TV ratings? Consumer sentiment edged higher this month, according to the latest report from the University of Michigan. Consumers upbeat about their job prospects and future incomes, though there is growing concern about rising prices and higher interest rates.
It is time now for our weekly market monitor, who has a list of stocks that he says are a bargain and may also benefit from inflation. Joining us is Barry James, President and Portfolio Manager with James Investment Research. Always good to see you, Barry. Welcome.
Hi, great to be with you.
Let's get right to your picks. You're going basic materials for the first one, and you like Louisiana Pacific. Why?
Well, just from the inflation standpoint, we finally hit the Fed's target of 2%, and we're seeing lots of businesses and the producers saying that prices are rising, so that should help out in timber prices. They have a specialty product called Oriented Strand, and it's used in all kinds of construction and also in furniture. The company's cheap, and it's a stock that we like even in our mutual fund, the Golden Rainbow, because it's cheap. It has very good and growing earnings, and the price has been in an uptrend. A little bit of a pullback recently, so that makes it a little more attractive, and hopefully it can hold up well if we do get this inflation.
I love it when you say Oriented Strand, Barry. It just really tickles me. Let's go to basic materials. Sticking with basic materials, Alex, for $20. Let's go to Steel Dynamics, tiptoeing into the steel area.
That's right. I know it may sound a little dull compared to all the technology world, but it's really, really cheap and really making money. And all these negotiations on tariffs kind of has the price depressed just a little bit. It has been helped, I think, but most of its sales, 95% of its sales, are in the United States, so it's not affected as much by by exports or anything of that nature. So it's doing real well, and I think it's got a good future.
Okay, precious metals next on the list. You have a couple picks here for us. First, the IAU, and second, the GLD.
Right, two exchange-traded funds that buy the underlying gold, and as we look at that, gold has done nothing this year. It's been buried in the bins of ignorance, and that's generally the case when the dollar is very strong. However, when we see the dollar, if it does start to get a little bit weaker, then that should be really good for gold. And the fact that it's ignored, it provides a good safety net.
How are you getting ready for the fall, Barry, in terms of portfolio management? Very quickly.
We see that there's some near-term potential risk, but the long-term flow of the market is so strong. I think there's a song investors are singing, if loving you is wrong, I don't want to be right. And so they keep putting money back in. And you even see that with Warren Buffett. His indicator says the market's really expensive, but he's in there buying. So okay. I think that's kind of where everybody's at.
Barry, have a great long weekend. Good to see you as always.
All right.
Barry James
Good to be
with
with
James
you.
Investment Research. To read more about Barry's picks, head to our website, nbr.com.
Big Lot shares take a slide, and a big one, and that's where we begin tonight's market focus. The discount retailer missed earnings and revenue estimates. The company cited higher transportation and fuel costs, which offset stronger same-store sales. Also gave weak guidance for the full year. Shares fell 10% to $43.05. The hospital operator HCA Healthcare said it will buy nonprofit hospital system Mission Health for about $1.5 billion. The deal puts additional hospitals under the HCA corporate umbrella. Shares of HCA Healthcare up 2% on the session to $134.11.
United Continental is raising baggage fees on a number of flights in response to higher fuel costs. The airline said customers can expect to see an increase in bag fees on routes to and from North America, the Caribbean, and Central America. United will now charge $30 for the first checked bag. That's up from $25, and this follows a similar move by JetBlue. Shares of United rose a fraction to $87.42. And investors had their first chance to react to American Outdoor Brands' stronger than expected quarterly report, which was out after the bell yesterday. The parent company of Smith & Wesson said increased promotions and stronger demand for its new products helped its results. The company also gave an upbeat outlook for the current quarter. Shares took off, rising more than 43% to $14.03.
Wow. Football season kicks off next week, the pro season that is, after a tough 2017 season when viewership fell nearly 10%. Now the NFL has come up with a new strategy it hopes will give a much-needed boost to ratings. Julia Borston has the details.
After relying on TV as the cornerstone of its strategy, the NFL is doubling down on digital, enabling football fans to live stream all in-market and primetime games from any mobile device. The NFL's streaming deal with Verizon in the U.S. will enable 400 million phones and, for the first time, tablets to watch for free. That's up from the 100 million Verizon phone subscribers who could watch live last year. The games will be available on Verizon's properties such as AOL and Yahoo, plus the NFL app, and Amazon and its Twitch service will stream 11 Thursday night games.
Our first goal in more digital distribution is just reach, is to get to people who may not be in front of a television. I think it remains to be seen if it will drive people back to television. What we do know is that when people watch NFL games on smaller screens, it's usually a stopgap to get to a bigger screen. I mean, they want to watch it on the biggest screen possible.
And the NFL is hoping to reach a generation of mobile-first millennials to get them excited and to transition some of those digital viewers to watch on TV. The question is whether this strategy helps turn around ratings. After last season, NFL ratings declined nearly 10%, and in 2016, ratings fell 8% from the prior year.
The focus here is not to compensate for a decrease in ad revenue. In fact, I think the volume of ad revenue in NFL football is up this year. It's more about continuing to increase the reach of NFL football for anyone who is almost living exclusively in a digital world.
To boost engagement amongst all its viewers, the NFL is working to make ads less intrusive, expanding formats it tested last year, including fewer breaks, showing ads on a split screen, and showing more 6-second spots. We'll see how these changes impact next Thursday's ratings. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, real estate's new best friend.
Remember Jeff Skilling? Well, let me remind you, the former Enron CEO, today released from prison. Skilling, originally sentenced to 24 years for his role in one of the biggest corporate fraud cases in history. Enron went bankrupt in 2001, and its collapse at the time was the largest in U.S. history. Skilling's sentence was reduced to 14 years, and today he relocated to a halfway house.
Well, there are many things, of course, to consider when you're buying a home. Price and location often top the list, but more millennials are making decisions based on the needs of their pets. Yep, you heard that right. Diana Olick explains.
31-year-old Jessica Evans lives in Washington, D.C. with Lucy and Casper. She calls them her fur children.
While I want to have kids one day, I'm not at that point in my life, and I think a lot of millennials here in DC are kind of in that same boat, but you still enjoy having something to take care of.
And taking care of Lucy and Casper meant buying this house.
I loved living in a downtown area in a condo. It was great, it was very convenient, I didn't have housework, but the one thing that was really missing was my dog's happiness.
And she is far from alone. 73% of millennials currently own a pet, according to the American Pet Products Association. That's more than any other demographic. And a whopping 89% of millennials who've bought homes so far this year own a pet, according to Realtor.com. That has millennials putting their pets' needs front and center in real estate decisions. 79% of pet-owning homebuyers who closed this year said they would pass up an otherwise perfect home if it didn't meet the needs of their pet, according to Realtor.com's survey. Jessica knows this firsthand because she's also a real estate agent.
A lot of times they really want a yard. They really want some outdoor space, and that does sometimes mean people moving out of the city, even though they'd love to stay in the city. The challenge of having a lot of stairs can be difficult for people with older pets. Having a place to wash your pet is a big deal. Proximity to dog-friendly places, like if you don't have a car and you have a dog, being able to walk to your Petco or PetSmart or pet store, like that's a big deal.
And once they buy a home, millennials will also put a lot of money into it to upgrade it for their pets. Jessica did.
Probably like $12,000 on it.
That $12,000 paid for a higher fence, a pet door, and even a renovated basement bathroom.
I wanted to have her own shower so that I wouldn't have to clean mine after washing her in it.
Because after all, pets are people too. For Nightly Business Report, I'm Diana Olick in Washington.
My dogs do not have their own shower. There's no way. To read more about Diana's story on our website, you can go to nbr.com. Ty?
And before we go, let's take a final look at the day on Wall Street. The Dow was down 22 points. NASDAQ, though, was up 21. That will buy some pet food. And the S&P 500 rose a fraction. For the month, there you see it, the big winner. Look at NASDAQ, up nearly 6%.
I hope my dogs weren't watching that report.
They're going to want that upgraded bathroom downstairs.
Unbelievable.
Have a great weekend, will you?
Yes, you too. And you as well out there. Thanks for joining us. I'm Sue Herrera.
I'm Tyler Matheson. Do have a great weekend, and we'll see you Monday for a special Labor Day edition of Nightly Business Report.